Thank you. Well, despite the warning, I will take questions at the end, so you can start thinking up your questions. Good morning. It's really pleased to be here at the University of Albany. As you noted, I went to UC Berkeley for my graduate degree, so I'm a big fan of state university educations, which I think is really important as a vehicle so that people can have upward mobility in our society. And so I really commend everything that the university here does. It's always a pleasure to speak with students and faculty because of the intellectual leadership role that you play in your community. And I'm also very welcoming the business leaders who are here today because you really shape the economic landscape in this region. So thank you all for coming today and helping to make this such a great audience. Over the past 20 months, I've been engaged in a series of outreach meetings all across the New York Federal Reserve District. I think these meetings are just as important as what I do when I go down to Washington because, or when I go to Switzerland, to Basel, to worry about international regulatory policy. The understanding of the issues and concerns that you have that I'll gain today is going to be very important in influencing my policy decisions, and it really makes it possible for me to reflect the public interest in everything that I do in the broadest sense. As you may know, the New York Feds District includes all of New York State, 12 counties in northern New Jersey, Fairfield County, Connecticut, Puerto Rico, and the U.S. Virgin Islands. In August, I met with community leaders in business and elected officials in Newark, Patterson, and Jersey City. Earlier this year, I went to Brooklyn, the Bronx, Queens, and Puerto Rico. And last year, I took a tour through upstate New York, so it's about time that I got here. My trip started yesterday with a policy speech down at West Point to the West Point cadets, and then was followed up with a discussion with their economics faculty. So this visit to the Upper Hudson Valley, I think, is very valuable to me because it brings me in contact with some of the country's future leaders, people here in the room, and also obviously the cadets that I met with yesterday, who will lead our country in very important, if somewhat different ways. I'm also obviously going to have a chance today to see more of what makes Albany so distinct from downstate and the rest of upstate New York. Of course, I would argue that I have a leg up on this because I was born and raised relatively close by in western Massachusetts. Go about an hour due east, and you'll come to where I was raised. The greater Albany area is home to 900,000 people. It's roughly the size of 3 average cities in the United States. And this area is noteworthy in the sense that the people here are highly educated, and a lot of them are employed as public servants. Those are factors that I think that makes the Albany region feel special. Today what I want to do is talk to you first about the Fed, what we do and why we do it. Then I'll give you my views on the economy nationally and locally. It's obviously a serious issue for all of us because it affects your families and students' jobs prospects as they get to graduation. So what does the New York Fed do? And what makes my job so interesting? Now, before I get into this, let me just say that what I have to say today reflects my own views, and not necessarily those of the Federal Reserve or the Federal Open Market Committee, also known as the FOMC. I say that in every speech. It's very, very interesting. I'm the vice chair of the Federal Open Market Committee. It's a Federal Reserve Committee that meets 8 times a year in Washington to set interest rates and make other decisions about monetary policy. The members of this committee all strive to set a policy to advance the mandate that was given to the Fed by Congress, which is to promote the maximum level of employment consistent with price stability. Now, sometimes we have different views on the specific policy choices that we should make. You should view those differences as completely appropriate. These are hard questions, particularly at times like this. And I think we make better decisions as a committee because we don't all think alike. But we are united in our commitment to the mandate, in our belief that the Fed's independence is essential to the public interest because by being politically independent with respect to monetary policy, this allows us to take the tough decisions insulated from short-term political pressures. Now, at the FOMC meetings, each committee member presents the current outlook for his or her region and the country as a whole. And for these assessments, we consult our researchers and we add critical information that we get from our boards of directors, and Charles Waits here in the audience today from our board, regional advisory councils, and community leaders such as you and others that I'll meet on this trip. As noted, I'm going to the Nanotech Center and Global Foundries. I'm also going to be meeting with the Capital Region Economic Development Council, and last night we had dinner with Rensselaer, the Polytechnic Institute, to talk about technology transfer. Now, at the New York Fed, we continually track conditions in our district. We've created a number of tools for that purpose. For example, my staff produces monthly indices of economic activity for New York City, New York State, and New Jersey. These indexes are similar to measuring gross national product, what's happening to activity at the national level, but just on a more local basis. They provide a more complete gauge of activity than just the unemployment report, which is really the only other metric that we have at the state level. We've also started a consumer panel to track household credit conditions, including the amount and the type of debt owed by the average person and whether those people are being able to make payments on that debt in a timely way. In addition, we have a new poll about credit and financing for small businesses, which is our important source of new jobs. The survey asks firms about credit applications and the reasons for why they're either seeking or not seeking credit. We had almost 900 regional businesses respond to our May 2011 poll, and nearly 15% of those were from the upstate region. The next poll is going to be in January, so if you are part of a small business, we would very much like you to participate in our January poll. So if you would like to participate, please give the card to one of us, and we'll make sure that we send you the poll, and we'll tabulate your results as part of that effort. Next month, we're going to host a workshop for the New York City's metro area small businesses to provide information about how they can participate in the global economy and expand their companies by exporting their products and services. The Export-Import Bank, the Small Business Administration, and the U.S. Department of Commerce are all going to be on hand for that meeting. They will tell participants how to tap demand in the global marketplace and what government programs are available to enhance credit, reduce payment risk, and increase lines of working capital. We're also facilitating a speed mentoring forum in which small businesses will receive feedback about their business plans and advice about how to apply for financing from a range of finance professionals. And in 2012, we're planning similar events for the capital region. So we're hoping to partner with many of you to support the small business sector that's very, very important to economic growth in the United States. Now, as you know, even states as wealthy as New York do have large pockets of poverty. So we also target some key initiatives specifically to low and moderate income households. We've worked hard to help neighborhoods that really face high foreclosure rates. For the past 3 years, we've provided housing advocates, including the Empire Justice Center, with the latest information on mortgage conditions via roundtables, presentations, and newsletters. And to share all that we learn about our district, we have a rich website, so I invite you to visit newyorkfed.org, that's newyorkfed.org, to explore some of the information they have, highly localized maps and information about small business, credit, housing conditions, and even we have the latest job openings at the New York Fed. Finally, and crucially, in the aftermath of the financial crisis, we're working with our colleagues in Washington and at other agencies to try to put the nation's financial system on a firmer footing. There's still quite a bit to be done there, though, so we're determined to keep at it. I recognize fully that there can be no return to pre-crisis business as usual, whether on the part of the financial sector or on the part of regulators like myself. So as you can see, all in all, there's plenty to keep me and my colleagues very busy. So now let me give you an update about the national economy. We stand here several days after the beginning of the worst financial crisis in modern times. And the origins of the crisis are complex, but I think we know that it had its roots in the bursting of a credit bubble that had grown to great size by the middle of the last decade. Prior to the onset of the crisis, a combination of rapid financial innovation and imbalanced global economic growth resulted in a mispricing of risk worldwide. This was particularly extreme in certain markets, and in the U.S. you could certainly point to U.S. housing and housing finance. Now, this mispricing of risk led to a misallocation of resources and an excessive buildup in many parts of the global economy. Many, though not all, U.S. households responded to the fact that credit was readily available by taking on more debt. When the housing boom lost steam and began to burst, expectations that housing prices and wealth would just continue to go upward indefinitely were very much disappointed. The bursting of the credit bubble, of course, also created instability within the global financial system, and this in turn resulted in a sharp tightening of credit availability to households and businesses. The result of those confluence of factors was what we now call the Great Recession. Over the period from late 2007 through the middle of 2009, real GDP declined by more than 5%, making this recession the longest and deepest since World War II. In the United States, the recovery has begun, but it has proven to be persistently weaker than expected. Growth has been insufficient to bring down the unemployment rate significantly, or to achieve this kind of self-reinforcing cycle that we like to see of strengthening confidence, demand, income, and employment. Although the latest news on the U.S. economy is somewhat more encouraging than what we saw earlier this year, I don't think we should take too much solace from that. After a very weak first half, when real GDP growth was less than 1% at an annual rate, economic activity has strengthened somewhat, and inflation pressures are also starting to ease. Growth in the third quarter is currently estimated at 2.5%, and recent indicators suggest growth in the fourth quarter could be a bit higher than this. This modest rebound reflects in part some passing of some of the transitory factors that were dampening activity in the first half. For example, the rise in energy prices and food prices that we saw earlier in the year, as well as the supply disruptions that emanated from Japan following their tragic earthquake and tsunami. However, as we look towards 2012, the U.S. economy continues to face several obstacles to a robust recovery. So we're expecting growth to be a little bit better than this year, around 2.75%, but still not as strong as we would like. Consumer price inflation has begun to moderate. This moderation is just starting to become evident in the 12-month change in the consumer price index. But given the trend of energy and gasoline prices, and looking at what future prices have priced in for the future, it looks like that consumer price inflation on a year-over-year basis should start to fall over the next few months. And when looking at the economy, I think it's fair to say that we cannot be satisfied with the current state of the economy or the outlook for the next year or two. The economy is operating far below its productive potential, leaving the level of output, income, and employment much lower than they would be if the economy's unused resources were fully put to work. One summary statistic says it all. The unemployment rate is currently unacceptably high at 9%. Given my outlook, the decline of unemployment over the next year is likely to be modest. Furthermore, we continue to face significant downside risks to the outlook, mostly related to the stresses that we see in the Eurozone. In a speech yesterday at West Point, I highlighted the need for our nation to develop a full set of economic policy tools to better secure the recovery and build for the long term. This includes monetary policy, of course, but it also requires policies to help repair housing markets, fiscal policy that supports growth in both the short run and the long run, and structural reforms that would improve our competitiveness and support a shift in economic activity towards a more sustainable growth path than what prevailed during the last business cycle. So how is the recovery proceeding in the state and the region? Well, as I mentioned, the New York Fed produces economic indices to help monitor conditions in New York State. Based on our index, the downturn in the state's economy ended in November 2009. Since then, I would describe the state's economy as recovering at a moderate pace, although there appears to have been a flattening out in September. New York Fed also conducts an Empire State Manufacturing Survey to learn about conditions for regional manufacturers. And I'm pleased to say that the November's report, which was released earlier this week, actually shows signs of stabilization after 5 months of weakening. In November also, more manufacturers are more optimistic about the future. Like many other large states, New York has a bifurcated economy. New York's downstate area differs dramatically from the upstate in terms of industrial composition, occupations, and job growth. While Albany may be geographically midway between the two areas, its industry mix resembles neither the downstate's heavy concentration on the service sector nor the upstate focus on manufacturing. What sets Albany apart, of course, is that it's home to the state's capital. So about a quarter of the employees in the Albany area work for the government. That's about a third more than the statewide average. The local economy here did not fare as poorly as the national economy during the recession, but the impact was still severe and the recovery is not yet well established here. During the downturn, the capital region saw a loss of about 20,000 jobs, or roughly 4% of total employment. That's considerably less severe than the 6.5% nationwide decline. Over the past year and a half, job losses have slowed. But in contrast to the rest of the state, we cannot confidently say a solid recovery is in place here yet. The Albany area is not yet consistently adding jobs. Now, this is not surprising considering the fiscal difficulties faced by New York State. The state has cut a considerable number of government jobs and reduced other expenditures as part of its efforts to close a significant budget gap. And these job reductions have disproportionately weighed on Albany's local economy. Now, in contrast, I'm pleased to say that when you focus on private employment, things look better. The Albany economy is showing signs of recovery. Your private employers have been adding jobs at a fast enough pace to be sufficient to offset the public sector job losses. However, this job creation has not been robust enough to bring down the unemployment rate, which remains at about 7% of the workforce. That's a lower rate of unemployment than for the nation as a whole, and this is usually the case for Albany. However, it's almost double the jobless rate that we saw here in early 2007, and that jobless rate has barely budged since the recession ended. It's going to be difficult for growth in the region's economy to resume and for unemployment to decline until the public sector stabilizes. Now, an important plus for the local economy is the capital region's housing sector, which actually weathered the economic storm relatively well. As a result, the drop-off in economic activity that's connected either directly or indirectly to the housing sector has not been as severe here as it's been for many places in the country. Like most of upstate New York, Albany's housing market has proven more stable. During the 2000 to 2006 housing boom, Albany's home prices rose by 85%. That's much higher than the roughly 50% average increase in upstate New York as a whole, and nearly as high as the doubling of home prices that we saw nationally. But unlike the rest of the nation, the region's housing market has been comparably stable since then. Prices have declined only about 7% from the peak here. That compares to a 32% average decline nationally. So the bust has been very muted here. Nevertheless, declining home prices coupled with sluggish jobs recovery have increased the financial pressures on families in this region. During the recession all across the country, we saw high levels of debt leading to soaring rate of delinquencies. Many families found that they needed to reduce their debts to more sustainable levels. So what's going on here? Well, drawing on the special consumer panel I mentioned earlier, I can tell you that trends have certainly affected people in this area. But the good news is the effects have not been quite as severe here as they have in much of the country. Households in the Albany region did not accumulate as much debt as did households in the rest of the state or in the country as a whole during the run-up to the crisis. Recent data indicate that the average adult in Albany has about $40,000 of debt. That's about 20% lower than the average across the state and the country as a whole. Thus, the financial strains on many families in the Albany area were lower than in many other places across the state and the nation. Despite this, though, the number of delinquencies did rise significantly during the recession in this area, so it's clear that some households still are facing significant financial pressures. About 4% of debt balances are currently 90 days or more past due in this area, which is twice the 2% delinquency rate we saw in 2005. Although that's less than half the rate of New York State or the nation, this doubling of delinquencies in Albany still troubles me because it does show that there are signs of heightened distress for many families here. Now, stepping back from the current challenges, I think the Capital Region possesses a number of fundamental strengths, and I think these strengths show through in a number of key ways. First of all, Albany is growing. The recent census shows that the population in the region expanded by 5.5% over the past decade. That's more than double the statewide average. And Saratoga County saw especially strong gains of nearly 10%. Incomes in the region are high. Albany is the state's most affluent area outside of New York City. Median household income was roughly $57,000 in 2009. That's moderately above the statewide median and well above the national average. Not surprisingly, then, the poverty rate is lower here than for the U.S. as a whole, 11% compared to 14% nationally. Residents here are highly educated. Educational attainment, which I think is a very important driver of economic activity, is also well above the national average. A third of the adults who live in the Albany area hold college degrees. And one of Albany's key strengths, as we're here today, is its higher education industry. The colleges and universities in the capital help stabilize the local economy during downturns. Indeed, the private education sector continually added jobs before, during, and after the Great Recession, both nationally and locally. For example, the University of Albany has taken a lead role in shaping the next generation of financial professionals and regulators through its pioneering curriculums. And from my perspective at the Fed, a particularly important and timely example is the university's innovative National Science Foundation-supported program for instruction and research, something dear to my heart, financial market regulation. Research conducted by the New York Fed has shown that colleges and universities can help build the skills and education of their region's workforce, and I think that's absolutely critical to an area's ultimate success. And they do that in two ways. Most directly, colleges and universities support an educated workforce by producing new college graduates, some of whom stay to live and work in the region. And the University of Albany clearly plays an important role in the capital area. Perhaps equally important, though, in terms of promoting local economic growth, colleges and universities can play a key role in creating jobs for skilled workers in local businesses. And that's something that we were talking about last night with Rensselaer. Colleges and universities conduct research and development that can have important spillover effects into the local economy. Businesses in the region can take advantage of being close to these innovative activities and facilities to help them in their development of new products and technologies. This can also draw new companies to the region to access the university's resources, so you get a virtuous circle going. The successful industry, higher education partnerships can provide quite a boost for a region's economy. The local nanotech sector obviously provides an excellent example of this type of partnership at work, and I'm going to be visiting the University College's Nanoscale Science and Engineering this afternoon. So I'm really looking forward to seeing the facilities and hearing more about the center's plans to lead the way, not just in national nanotech research, but in global research. More broadly, I understand that our audience today includes several members of the Regional Economic Advisory Council, obviously the president, George Phillip, and Michael Castellana, who's the co-chair of the council, who are working to advance such partnerships and the outlook for the region. Going forward, the industry higher education partnerships taking place here, I think, will be increasingly important. I expect the strong foundation already in place here will be very, very important in maintaining the economic vitality of this region. So to sum up, growth has picked up modestly in the second half of 2011, but not enough to bring the unemployment rate down. While there are some bright spots in the U.S. economy and the financial system, strong headwinds are preventing a more vigorous recovery. Inflation, which has risen over the last year, is posed to moderate soon, and the Fed is doing and will continue to do everything within its power to promote both jobs, growth, and price stability. Looking ahead, the key challenge for the Albany area will be continue to prepare its residents for the best jobs being created here. So expanding education and skills, that's going to be very important in broadening participation in the economy to all residents. So thank you for your time and attention, and now I'd be very happy to take those tough questions.